Welcome on in. You're watching Lowcountry Money Talk. It's good to be back in studio with you.
Oh yeah, I'm glad you're back.
Oh, me too.
Okay.
You know what? I've missed a few things, but I've been paying attention. I've been watching, following your lead.
Sure.
Lots going on as usual. Still a lot of market volatility, of course.
Always.
The good news, though, folks, is that we can learn something here.
Sure.
I think there's a lesson in challenge. So what is it that we should be learning?
Well, the first thing, we don't want to be paralyzed by what's going on, so we don't want to be like a deer in the headlights. We need to take problems and make opportunities. So we do have a lot of volatility based upon what the federal chairman, the chairman to the Federal Reserve said this week. This is going to continue, and he was saying a couple years. That doesn't mean the stock market's going to be bouncing all over the place for a couple years, but he said this week that he didn't expect inflation to get under wraps until 2025.
Wow, that seems like it's so much further out than I was expecting.
Not a quick fix.
It's not a quick fix. Okay, so inflation is, I guess not going to really get under control, meaning the Federal Reserve is likely going to continue to increase interest rates in an effort to really kind of slow that economy down.
Sure.
So what does that mean for retirees? What should they be thinking about? How is this going to impact them?
Okay, with the inflation. So if everything costs more and I'm on a fixed income or I'm taking a certain amount out of my investments each month, I'm going to have to take more out, right? So then the problem is, if I have too much invested in the stock market, which is heading down more, I'm going to take more out of something that's heading down south. So probably don't want to do that. So I think what we do is say, first of all, do I have the right amount of my retirement savings at risk in the stock market, or do I have too much?
Yeah.
That's number one.
Okay.
So if I have too much, I really need to adjust that, because I believe the market's not done going down.
Yeah.
Because if we look at historical bear markets, typically that S&P 500 index will go down around 35%, and we're at 20 now. So
we got a ways to go if history tells us anything.
Well, so the point being is, I need to get that percentage or that ratio corrected first, okay? The next thing I need to do is I need to get some return on my investment that's not going down in the stock market, so that's one thing. But first of all, we need the percentage right. So if I'm 70, maybe I should really only have 30% in risk assets. The second thing we might want to do is, how can we lower our taxes? Most people are paying too much in taxes. I think the viewers would agree. So let's take a look at how we're doing the withdrawals from our assets to buy things that we need or for our monthly income. And if we can lower the taxes on our withdrawals, then maybe that will satisfy some of these inflations. The other thing that we can look at is lower our expenses of our assets. So if we're paying too much in expenses for the management of our 30% or our overall portfolio, if we could lower that, then maybe we can make up for some of that inflation. Because remember, Jessa, inflation is 8.3 year over year from August. But the problem is, what was the inflation last August?
Right.
It was over 5%.
So it's just compounding each year.
Yeah,
Yikes.
so really, we're paying well over 13% more. And then if you look at the prices of food and stuff, it's way over that,
Right.
And I think if we look at our last CPI number, it was with the oil prices down and the gas, well, that's going to change and they're going to go back up because we have this 1 million barrels a day coming on the market through our strategic reserve that ends in October.
Okay, well, the good news is for your clients, Phil, I know that you really look ahead and make sure you're adjusting for these different factors, for inflation, for interest rates changing, tax change, all these different things, so that you're not just holding on for dear life and hoping for the best.
Right.
You've got a plan. So we're going to talk more about that and a little bit about what you should be making sure you're taking a look at for our viewers out there who are in or nearing retirement. And the good news is we have expert Phil Bloyd from Revolutionary Financial Group.
Absolutely.
Going to be back after the break. Stick with us. Welcome back. We are still here at the desk. This is Lowcountry Money Talk. Phil Bloyd hasn't gone anywhere. He's stuck around. He's our expert with the Revolutionary Financial Group. Really an expert. I think lots of folks say they are, but Phil is the real deal. It's nice to see you.
Good to be back.
Lots to continue to discuss.
Sure.
If you're just joining us, we're just kind of walking through some of the things that you need to be mindful of during market volatility, things you might be aware of during inflationary periods. And it's time to really discuss, where it is a good place to take income from right now, because it might not be the same place that we're used to.
Sure.
So walk us through that.
Well, Jessa, a lot of people during I would say the volatility of the market these days and inflation, we talked about them being paralyzed and just, I gotta leave everything the way it is or this or that. Actually, I get pretty involved in these time periods, so it's important that you have an investment advisor that is proactive and that we develop some strategies instead of staying, everything will be okay, the market goes down, the market goes up, these things we know, okay? But what can we do during this time period to have some strategies, be a little more strategic about things than just, okay, by the way, we'll just kind of wait? Because in 2008 and 9, when we had a 50% drop in the S&P 500 index, it took about 5 years for those indexes to get back.
Right, and some of us maybe can wait that out, and some of us might not be able to, depending on where you're at.
Well, if we need income out of our savings, we still have to take it out, whether it's an up or down market.
Right. Okay.
If we're 72,
yeah,
we have to take our IRA distributions. 5 years in a down market.
Okay. Yeah. Ooh, that's a face I think a lot of our viewers are making at home too. A face we've all made recently.
Right.
Okay. So you talked in some of our previous shows about these 3 buckets. I think that helps really organize it in our minds. Just kind of walk us through those 3 buckets and what your strategy might be.
Let's do this. Okay. So I need income. The market's down. We already took care of step 1, and we said, okay, based upon my age, I fixed it so I don't have so much at risk in individual equities or whatever anymore. So I took care of step 1. Step 2 would be, hey, I need income. Okay, where are you getting your income from now? A lot of people just run to their IRA and take income. I'm like, time out. Maybe we don't want to do that. So do we have other sources of income first? So the first thing we look at, a lot of our retirees, they have too much in their checking and savings. For an emergency fund, Jess, we want 6 months expenses.
Right, which might be tough for some folks to keep it at that.
Yeah, 6 months expenses. So let's look there first, checking savings, okay? If you've already got that covered or you're a little under that, I'll talk about that in a minute. But let's say that you're one of those people that says, I like to see $100,000 in my checking account regardless.
That feels comfortable maybe,
yes.
Right? Safe.
And if we can, I always try to accommodate for that. But, when we're in tough times, we got to change things a bit. We may have to get out of our comfort zone just a bit. So if I'm taking $2,000 a month out of my IRA and I'm in a 20% bracket, or let's say 22%, but let's just say 20 to keep it even. So I have adjusted taxable of about 20%. So about $400 a month would be taxable of my 2,000, let's say. So if I'm under 72 and I don't need that, and I have 100,000 in my checking account, I want you to stop. You've got your 6 months expenses covered, and you got a whole bunch more. So let's stop taking that 2,000 a month out of the IRA. That'll save us $4,800 in taxes. That'll help overcome some of that inflation and some of those things, right? So let's do that first. Okay, now let's say that I can't. I'm already at my 6 months expenses in my emergency fund. You know what? We're gonna pick up there. I think that segment. Okay.
Boy.
Boom! It went fast.
Wham!
Okay.
But no, this is great information. So we'll make sure and continue
We'll
that discussion as we're half done. Oh my gosh.
Quick.
We have a whole bunch more for you though. We'll be back after this. Stick with us. Okay, we are back here, and we went to break in a flurry. Boy, we had to get to break. we got lost in the moment talking about where to take income. If you're just tuning in with us, of course, Phil Bloyd is here with Revolutionary Financial Group, helping walk us through, sometimes what might be a little bit of tough times for us financially. So the important thing, though, Phil, that I've learned from you is we make these adjustments, and even, adjustments like where you take income.
Right.
So, on the front half, before we went to break, we were talking about, what does your emergency fund look like? And I know there are folks out there that really like to see a good bit in their emergency fund so that they don't, it makes them feel good, warm and fuzzy. But what if you're somebody who doesn't have the extra in your emergency fund to make those adjustments? Let's say you just have the required 6 months.
Yes.
Then what do you look at?
Let's look at bucket number one, behind curtain number one. Let's make a deal. So the first bucket we'll talk about after, say we're down to our 6 months expenses and we don't have the extra, so we have to take some out of our assets. I want to look at the capital gains bucket. Okay. So the capital gains bucket would be not a non-IRA, a typical brokerage account that's not an IRA, and maybe we have stocks and different things in there. So we have the opportunity to do some tax harvesting. We spoke about that in the past on some shows, but our tax harvesting would say, if I have a stock that is down in value, and maybe I have one that I've had for years and years and years, and I can offset some of the gains with the loss and then take a withdrawal out of that capital gain bucket at basically a zero tax.
Okay.
So that may be the next best place after the emergency fund, because I'm taking money, but I'm not paying any taxes on the withdrawal as I would on the IRA.
As you would on the IRA, okay. So you've kind of got your layers of priority here.
Yes.
So that's layer number 2.
Yes.
Let's say we're stuck and we don't have that as an option.
Oh.
Now what do we do?
Okay. Curtain number 2. Or bucket 2.
Yeah, bucket 2, curtain 2. What's back there?
Bucket 2, we have to, well, let's say we're over 72, we have to take money out, or we've already exhausted the other 2 opportunities, and now we're at the point we have to take money out of our IRA. So every dollar we take out of there is taxable. So the thing I'm going to look into next is, what are you invested in your IRA? Is there any way that we can adjust the expenses from your IRA? Quick example. Let's say I have an IRA and I'm managing it myself. Okay, what is your investment vehicle? Is it a fund? Is it an ETF, a mutual fund, or whatever? There are expenses involved there. So let's take a look at the expenses on those assets first. Let's see if we can switch that investment around, maybe get the same outcome that we're looking for, but maybe if we change the vehicle from mutual fund to exchange traded fund, or we get maybe an exchange traded fund that's much less in expense than the one we're in and has the same overall objective, or we go from a mutual fund, which may be higher in fees and expenses, to an exchange traded fund, same objective but much lower expenses. So we want to do that.
Okay, yeah.
So we can get funds out, we're going to pay taxes, but we're losing less to expenses. Here's a big problem I wanted to talk about. We don't have a lot of time, but I'm going to try to get it in.
Okay.
A lot of people have done the 60-40 portfolio, meaning 60% in bonds, maybe 40% in equities, or vice versa. And they thought, well, by doing that, I'm in these bond funds, or I'm in these bond ETFs. So if the stocks go down, I can take money from the bonds. Well, the problem is the bond rates are really bad. So if I take money now from my bond ETF or my bond fund, I'm also going to be down 13 to 15%. So that's not a good option either. So if I need more money than the yield of these bonds or these bond funds, I'm going to take remember we used to have a term called a haircut.
Yes, taking a haircut. Yes,
We
I
talked
remember that
about
now.
that.
Yeah.
Okay,
yeah.
so on Wall Street, instead of saying loss, they say haircut. You know
Right.
why?
Because it sounds nicer.
Yes, you're learning.
Way rather have a haircut than a loss.
Absolutely.
Yeah.
Well, we don't want either.
Right.
So, this is something we need to constantly be aware of. And the thing you need to do is you need to contact Rachel so that we can do that portfolio analysis.
Eye-opening, really eye-opening.
We can find those expenses.
Yeah.
We can look to lower those expenses. We can make sure that we don't have too much at risk. Now is the time.
Yeah, so make sure you do that because it's important to do and you might be surprised what you uncover. Okay, we got another segment,
Yes.
so we're going to wrap it up after this break. We hope you stick around for our final segment on Lowcountry Money Talk. Stay with us. All right, we're going to wrap it up for you today here on Lowcountry Money Talk with a really fun segment. We're going to answer some of the viewer questions. I love it. And you all know Phil Bloyd. He's back, of course. I'm always excited when you don't run out the door, Phil. We keep you around.
I was trying to.
We ask him some
Make
tough
it.
stuff.
It's locked.
That's right, we locked the door. We've got, though, a guest on the show today. Kyle Bloyd is here, the Vice President of Financial Services for Revolutionary Financial Group. Your title is a mouthful. I bet your job is, too, but we're glad to see you.
Thank you for having me. I appreciate being here. Feel like part of the team.
You are part of the team, a big part of the team. And you've got some questions that I bet a lot of our viewers are wondering, some questions we're going to answer for you today.
Yep.
Fire
I've got 3 questions we're going to go over. So, Phil, we have a few questions today from random viewers, and they just want to have a few questions.
All right,
So let's
do
go over.
it. I'm
Here's
ready.
the first question. We're both retiring in about 3 years. We have done pretty well and have about 10 different retirement accounts like 401ks and IRAs. But the problem is they are spread all over the place, and we're not sure what to do with all these retirement accounts. Which should we use first for income when we retire?
Right.
We've done a good job saving, it's just we don't know what to do now.
Okay.
What do you think?
Kyle? The first thing we want to do is kind of get a lasso and a corral and round all these IRAs and 401ks and whatever they are and get them in a pot so we can kind of see what's going on. So what I would do is have you come in. The other thing we want to do is kind of do an analysis. Now you're retired. We got to find out how much income you're going to want out of these accounts total. We're going to take a look and see how much in taxes, fees, and expenses. Are these meeting your objectives based upon your age? Do we have too much at risk, not enough at risk? So once we get all these rounded up and find a holding spot for them, then we want to make sure, hey, maybe we want 40% low risk, maybe we want 60% or whatever the ratio is for you and the suitability. And then we want to do that analysis, the thing we always say, call Rachel and this and that. So what I would recommend is give us a call, come in, let's rope these things up, get them in a corral, do an income plan for you, and get it all taken care of. And then, hey, put a strategy together.
Okay, sounds good. Main thing, they need to come in.
Yeah.
All right, let's go
That's
to
a lot of stallions to
Yeah.
round up by yourself.
10 of them, yeah. All right, here's the next question. My dad is 78, and we've been talking about his financial situation and trying to get his affairs in order. Before anything happens to him, I'm learning how unorganized things have been until now. And it seems like every other week he's calling me about another CD he found. He's remembering some of the other accounts he may have had. How do I make sure we aren't missing anything when we're trying to account for all of his assets?
Okay, I've been through this before, so in 30 years of experience, Kyle. So here's what we think of. I reflect back to a person that came to me years and years ago, and their father was 80, pretty close to this, okay? So he was 80. He was all over the place, so we brought him in. We, again, kind of similar to the last question, we rounded everything up. You don't know if he's got everything. Look at all of his bank statements. Look at all of his investment statements. Have him put his bills together for you for a full quarter, so you get investment statements. And there may be some CDs on his bank statements. Look at his checking, savings. Look at his checkbook, register, all these things. So once we do that, we're going to know where everything is. Okay, we're going to organize it. We're going to make sure that his estate is in order so that we don't have to probate or any of these things. Now, the other thing we want to look at is, in his case, if he wants, sometimes they will resist. So the father may resist and say, well, hey, you know, you're just trying to get my money. No, the best time to get your elderly parents' estate together is while they're still around and they can tell you what they want. So that's how I would explain it to them. And I say, hey, you don't have to do it. Bring him in and let me explain it to him. And I'll say, hey, this is how we get everything that you want done the way you want done. If you're gone, then we can't do that because I can't get your input anymore. You know what? We're not going to get to that third question, but maybe next time.
Maybe next time.
I like how you take the stress off the family member a little. Let the expert, you know, really handle it. Yeah, I think that helps a lot. Well, good news. We'll have to have you back, Kyle, and go over some more viewer questions. One thing that, you know, I recommend to everyone who watches this show, if you have $500,000 or more in investable assets, it's a great idea to call Rachel over at Revolutionary Financial Group. Get yourself a risk assessment and a portfolio analysis so you can really see what's going on. And speaking of seeing what's going on, we hope you see us here next time on Lowcountry Money Talk. See you next time.